Hey everybody, welcome to I Know a Guy. Today we're talking with Andrew. He's self-employed. He's been in the financial industry for years and years and years. So he's going to go into some detail about all he's seen there, what he does now. But Andrew, it's nice meeting you.
Good to be here.
Yeah. So how are where are you located at now? I think we talked yesterday. You
I'm in
moved.
Williamsburg, Virginia, a nice quiet little town.
Mhm.
It's
Yeah, you
pretty
said
nice.
you just moved up there, didn't you?
I did. Yeah, I was in the Boston area for many years, and I just moved away from the winters, basically.
Yeah, yeah, I get you there. A little bit different down in Virginia than it is up in Boston, I
Yes.
imagine.
Yeah.
So how long have you been down where you're at now?
Oh, just a couple months right
Okay.
now.
Well, what do you do for fun there? You found anything that you like to go do on the weekends or?
Well, I'm still getting settled in my house, so I haven't had a lot of time. There are things that go on in Colonial Williamsburg, that are interesting. I've done some volunteering here. I've been here for, a few months. I'm trying to meet people, just get familiar with the area. So no, I haven't really done much. But I mean, aside from taking my dog to dog parks and doing my strength training. That's basically what I do, fun. And then, the weekend drives, I mean, I haven't gotten out there much lately. I want to get up into the Blue Ridge Mountains and, explore a little bit out there. But no, I haven't really done much. Moving into a new house has been, has been an adjustment for sure. But anyway,
Yeah, no,
and in the
that,
meantime, I'm just trying to, really just trying to get my message out. I mean, I published my book in January and I'm working with my publisher on promoting my book. So that's really what I'm doing for fun. And I think, as I mentioned to you before, I tried retirement in about 4 years ago and I got really bored. And so then I decided to write a book. So I did, I published it in January. And then I decided that I really wanted to do what I love to do, and that is to help people preserve the value of their money over time.
mhm.
It's as simple as that. That's what I did for endowment funds at my business. I had my own firm for 25 years. And that's what I want to continue doing, but for regular everyday investors.
Mhm.
And also for people who are, well, really it's for anybody who has any money to invest at all up to, you know, a lot of money. The same principles apply.
Yeah, I got you. So what's the title of your book?
The title of my book is Beat the Wealth Management Hustle. And it just tries to point out that the industry, it tries to pull the curtain back on an industry that could be more transparent and could disclose a bit more. And it's just straightforward. And what it aims to do is to help people who do have advisors to improve their relationship with their advisor and to have a better understanding, mutual understanding of what they want to do and how they want to go about doing it if they don't already. And I found the reason I wrote the book is because it became clear to me that and the stories in the book. It's semi-autobiographical, but it's also talks about investing and how my journey through time and investing is really what it talks about. But it has some practical advice too, and some of the practical advice is here's some questions you can ask your advisor, and they're just the same kind of questions that institutions would ask, which is what I was. I was an institutional investor, so I had to follow a very strict structure and document my findings and present them to my clients and make judgments and present them to my clients. So it wasn't my process was rigorous, and all I'm suggesting to the average person or the individual investor is to invest the way an institution does and just ask some simple questions and get some answers. And everybody knows whether the answers are right or not. I'm not going to tell you what the right answer is. You're going to know it when you hear it.
Mhm.
And if you ask a question like to an advisor, like, what is your advantage? What's your structural advantage? How do you add value to my account? And if they can't answer that in a simple way, then, maybe you should be talking to somebody else.
Mhm.
And
Okay.
that's kind of the approach that I take. It's like when I say a hustle, I don't mean that the industry is a bad industry. I just mean that people should be more hold them to account. It's like, okay, so are you doing better than the S&P 500? Are you doing better with my money than I could do on my own? And it's as simple as that.
Mhm.
And in the institutional world, you have to come up with really good answers and satisfactory answers to those questions. Otherwise, you don't have a client.
Hmm. So how long did you say you've been in the industry?
Oh my goodness, it's decades. I started in the 70s
Mhm.
and out of my active duty, service. And yeah, I just stayed in the business and I did pretty well and ultimately decided I really needed my own firm to be able to
Mhm.
express my values and um, you know and to be yeah that's really it because I found that the practices in the industry could have been better. They could have been more transparent, and
Mhm.
I was transparent. And so, yeah, one of the things that my themes of my book is that people don't know how much they're paying their advisors, and which is pretty amazing since they're paying them a lot of money, and they're paying them every day. And so I'm saying that, well, you should understand what you're paying, you should understand what you're getting, and you should understand you can do it yourself and you can get competitive returns. Because if you're just paying for a comfort factor, then you should understand that. Okay. And, and also you should understand the market. And many people are intimidated by investing. And so they default to somebody. And so they become dependent on a wealth manager, which is fine. And if that makes them comfortable, fine, as long as they know what they're paying. And, the other thing people should understand, aside from the stock market history, which is important to understand if you're going to be investing in it, is that compound interest is really important. And most people don't really look at that in dollars and cents. And if you do, you might be surprised at the numbers.
Mhm.
And people are like, well, I really don't want to deal with it. It's too much time. I don't understand it. I'm intimidated. It's chaotic.
Mhm.
And I understand all that stuff. And that's what I discuss in the book is like, how do you put things in context? And
Mhm.
the market any given day could be reacting to things that most people don't understand, even professionals. And but is it significant to their strategy of their own money over their respective time horizon, which usually is longer term? It's usually more than 5 years, more than 10 years in most cases, or should be. And so is that significant to my strategy? Should I be making changes based on what, some event in the financial world that took place that I'm not sure I understand that, but, but everybody else is running for the hills and maybe I should too. Well, that's probably not the right way to look at it. The right way to look at it is to say, well, what does this really mean in the longer term, and how do I fit it into a context that is rational that I can understand? And
Mhm.
I mean, one example is in early August there was a government report of the unemployment rate, and it spiked up to 4.3%. And on that same day, the Japanese central bank raised interest rates by a quarter of a percent, and which caused some strategies to change radically, to no longer be effective. And there was a big market sell-off, both on the unemployment news and on this Japanese central bank interest rate increase that affected what is known as the carry trade, which, and I won't get into that, but most people don't understand what that is. And it's really not that important that they do it because it's something that doesn't impact most people. And the unemployment rate went to 4.3%, and the markets got very upset. And the reality is, the average unemployment rate for the last 50 years has been 6.2%. More recently, it's been down below 4%. But that's generally considered to be full employment. So that's not a reason to be alarmed because it's 4.3%. Now, it has since gone down, by the way, in the last month to 4.2. But so my point is simply that let's back up and look at this in context. What does this really mean? Does it mean I should change my portfolio? Does it mean I should be, selling my stocks? I mean, it might mean that to you, but if you do that, just understand what you're doing. And so that's where I come into the picture is try to keep it simple. And there's a gentleman who's in your neck of the woods who's pretty well known, whose name is Warren Buffett, who has been advocating that basic strategy for many, many years. And it's right. It's the right strategy. It's to invest in an index fund, um, keep it there. What's his favorite holding period is forever. So he doesn't have to be making changes. Every time you make a change in your portfolio, you take a risk of certainly making the wrong change. And if it's taxable, then you're incurring a tax liability. You have to pay taxes on any gains you might have had. In a retirement account, of course, that doesn't matter because there are no taxes in the retirement account. But why are you making that change? Are you
Mhm.
selling? Do you think you can buy back at a lower price? Well, that's a really hard game to play and win
Mhm.
at. Market
So
time, not good. Anyway,
yeah.
long answer to a short question.
Yeah. So you've been in it for decades, you said. If you were to start over, go back to the 70s or whenever you started, what would you do different outside of just having, foresight on some good stock picks?
Yeah. What would I do differently? I actually wouldn't do anything differently from a professional standpoint because
Mhm.
what I did really, and especially with my own firm, but also before that, but was to look at market history and believe the market. The market is always right. Okay. The market is always right. No matter what people may think about it, the price is the price. That's what it is. It may overreact in the short term, or even in the context of a couple of years, just as we've seen in certain bear markets. But it has always come back. The stock market has always come back. So I look at market history. I wouldn't do anything differently. I would say, well, it's pay attention to history of the stock market, and also instead of being fearful of investing as being a risky place, um, embrace the opportunity and take some comfort in what market history has told us, and that is that don't bet against our economy, don't bet against the United States, don't bet against the stock market,
Mhm.
because if you have, then it's been costly. And it's been the best way to preserve the purchasing power of your money over time. And that's not a little thing. That's a big deal.
Mhm.
That's a really big deal.
So that's all really, really good advice for new people starting, but more particular, if somebody was starting the day and they wanted to, be that value adding advisor that you were talking about, that, hey, some are, some aren't, but if they wanted to be that, how would you recommend them getting started? What would you recommend them do?
Well, I'd say if somebody wants to be in the investment advisory business, of course they have to get registered. So there's a fairly rigorous exam that the SEC, well, that FINRA, Financial Industry, Regulatory Authority, has. And so they have to do that. They might want to get a chartered financial analyst designation, but I'm not, they don't necessarily need that. In my experience, and what is my experience with my own firm? I advised endowment funds, and we had some fairly complex portfolios that were comprised of not just publicly traded stocks, but also some private equity and real estate, and in some cases commodities. So they were fairly complex, and I did a lot of research and a lot of due diligence on managers. And so but I always looked for somebody who could simply explain what they did and how they added value. And so I would say to people that if you want to be an advisor, you have to have a very clear uh, um, message of what your structural advantage is. How do you make money? How do you extract value over and above an index return? Because the reality is in the investment advisory business, the benchmark for professional investors has always been the Standard and Poor's 500 composite stock index. That's what it has been, rightly or wrongly. It's been a measure of corporate performance for nearly 100 years. It was 1926 when it was started, and it's done about 10% a year since then. Not without a lot of multi-year periods of declines that were significant. In the Depression, it went down 85% over 3 years, and it came back. Went down over 50% in the dot-com crash. It came back. It went over 50, down to over 50% in a year and a half in the great financial crisis, and it came back. It went down 35% in 30 days in the COVID crisis, and it came back. So will it continue to do that? It might not. Might stop doing that. But 100 years of history, it's kind of hard to ignore that. So the bottom line is that's the benchmark. Okay. So you have to, if you're going to be doing this professionally, you either have to say, I'm only going to put you in index funds, okay, because that's a good return because now you're going to be saving on fees because I'm not going to be charging, I can't charge a lot if I'm not going to be adding any value over the index return. But the reality is that many advisors are charging, let's call it 1%. That's the average fee, okay, the 1%. If you're going to be charging, what are you doing for the 1%? What's your advantage? Why should somebody pay you 1%? And so what is 1%? Let's say, so if you do earn 10% a year on your whole money, on your whole account, which is pretty good return, by the way. I mean, that's if you earn 7% a year, that's not bad. That doubles your money in 10 years. And that is really the target return that most retirement accounts have is a 6 or 7% a year return. It doesn't sound like a lot, but that's a lot of money. That's a big return. All right, so let's say it's 10%. You're paying one, so you're paying somebody 10% of what you earn to tell you to be invested in an index fund. What? Now, if you're paying them 1% and they're doing better than the index fund return after their fee, they have to make 1% plus some incremental return to really demonstrate the value add. Then that's great. Then you've got a really good advisor. But you have to, how do they do that? How do they do that? Do they shift allocations of assets frequently? Do they have a history of being able to identify undervalued sectors and to rotate at the margin into those sectors to add value to the portfolio? So somebody might rightly ask me, and I address this in my book, by the way, well, why the heck would anybody hire you? And the answer is we, my firm, basically had a profile of finding undervalued sectors that were basically inefficient financial market verticals. What does that mean? It means that it's sectors of the financial market that were not fully recognized by the institutional investor, by the general investment world. And so they were undervalued and therefore they were attractively valued, priced. And so we would find people who invested in those inefficient financial market verticals. And what were they? Well, back in the early 90s, believe it or not, it was in the information technology sector. There were almost no information technology specialized managers operating in 1990 in this country, maybe a handful, maybe 4, 5 or 6, maybe. And then 10 years later, everybody was an IT investor. There are investors who were in the life sciences area. There are investors in the real estate area and so forth. So we would find talented managers and allocate a small portion of a portfolio that otherwise was broadly diversified in publicly traded equities in those sectors to add value. And if you made the right choices, yes, you did. If you made the wrong choice, obviously it's going to detract from your overall return. But that's why we work so hard at it. And so we really were trying to identify people that had that were emerging managers that were generally they weren't institutional favorites. And we were basically looking at the institutional world and saying, well, the institutional investment world is structurally mediocre. What does that mean? It means that if you do as well as the market with your assets, then you're probably going to keep your account. Mm-hmm. Who's going to argue with that? And or close to it as well as the market after your fees. And even if it's a little under the market after your fees, people aren't going to be too upset. Well, you kept me invested, and we didn't do as well as the market, but we only made 9%, not 10%, but that's okay. We're okay. Mm. And so there's this, and so exactly if you're an institutional investor, you don't know exactly, but pretty darn close to what your competition is doing, mm-hmm. and where they're going to be putting their money. So we will try to position ourselves just a little bit away from that to take advantage of that bias. Mm-hmm. It worked.
So people are going to be able to learn quite a bit, it sounds like, from reading your book and, kind of knowing how they should talk to their advisor. But if you had one 30-second little snip that if somebody's new to investing or they're curious about finding the right investor or somebody that's going to help them or, just talking to their own, what's like a quick 30-second question that you would recommend that they'd ask so that going in that this guy has their best interest at heart?
Well, first of all, the short advice is you should put a little bit of money into the stock market every month and let it let it sit and let it ride. And that's the short advice. And that's called dollar cost averaging. Okay. So that's what I would say. That's the advice. In terms of somebody who wants to get into the business, again, you have to find a way that you can demonstrably explain how you're going to add value to a client's money.
But
And
more so on the client side, what would be like the quick question that they could ask their current advisor to say, hey, here's this, and then whatever that answer is, lets them know if
well,
it's
the client has to ask, how much am I charging and what am I getting for it?
Mhm,
And how do you add value? What is your structural advantage to add value to my
mhm,
portfolio? And if it basically boils down to, well, I'm always here for you and, I'm going to be here for you to answer your questions. Well, that's an answer, and then that could be enough value add for people to engage that advisor. But in the institutional world, that's like everybody that says that.
right. Yeah,
That's not gonna make
that's the
a difference.
baseline.
That's a baseline.
Yeah.
So, but the reality is that a lot of individual investors, that's fine. And the other thing is, I look at the SEC, the Securities and Exchange Commission, breaks investors into two categories: retail investors and institutional investors. And institutional investors have $50 million or more. Well, but to me, everybody, and they might be considered wholesale. To me, everybody's a wholesale investor, because now the world has changed so that even somebody with a small amount of $1,000 or a few $100s can invest for almost no fee at all, with very low minimums in most of the big firms. So the accessibility to this incredible machine that is the corporate America that generates these returns for investors is accessible to everybody.
Mhm,
I'm not sure that people really understand that. And by the way, half of the individual investors now are doing it independently. They're not going to advisors.
mhm,
Okay? So more and more people are doing it independently, which is what I think makes a lot of sense.
mhm,
Now, where do I come in? If somebody wants a coach, they have an advisor they're not so sure of, they want a second opinion, they want an objective determination of their own risk and return strategy. My site, by the way, has a no obligation, whatever, confidential risk assessment. It's a 5-minute assessment. People go through it themselves and see what their risk score is. And so I don't look at people and say, you're a conservative investor, or well, I can see that you're still making money. You're a young investor. You're probably an aggressive investor, right? And well, I don't know, I guess. But then what does that mean? What does aggressive investor mean? And so what I do is I put a score on it, and like we definitely define it. Here's your risk score, and here's what your portfolio risk score is. And if it's the same as the one you want, that's great. If it's not, then it has to be adjusted so that it is.
mhm,
Why is that important? It's because people are 2.5 times more concerned about losing money than making money. So that when the market goes down, they get very concerned and they might sell their position, which is actually increasing their risk of not achieving their long-term goal. It's not decreasing their risk, it's increasing their risk.
mhm,
Okay, after they had a loss. And so, but and all the wealth managers that I know would tell people, don't stay invested, stay the course, don't get upset when the market goes down. And that's the right advice. Or the better advice would be to, if you can possibly add to your positions after that, then do that. But
mhm.
at the very least, hold on to what you've got. And so, that's
Okay.
it's. I try to keep things simple in this what otherwise is people consider to be a intimidating process. It shouldn't be. It should be something that people feel good about, and they can do it, and they can enjoy their lives. Know that in the future their money is going to be worth enough to make a difference. It's going to be able to buy what they need to buy in the future.
Mhm. Awesome. So, okay. Yeah, we'll you clearly know quite a bit about this subject, years and years of experience. How do people get a hold of you if they want to, get your book, or if they want to contact you or work with you or do the coaching part with you? What's the best ways?
Yeah, yeah. Well, I would encourage people to go to my website, because it has and the website is very simple. It's victoryroad.com, one word. What does that mean? Well, that was my business address for 25 years. I was at 500 Victory Road. So I took that as a domain. URL, and that's what I use, victoryroad.com. If you go there, you'll see a 2-minute video on the process that I use at my firm, and also a lot more information and more videos on the following pages, and also the process. But even better, they'll get a no obligation risk assessment that they can go through. And yes, they will have to put their email address and phone number in there to get that. Yes, they will. But if they want a risk assessment, then that's how they can do it. And then if they want to take a look at their actual portfolio and load it with a link to their brokerage firm or advisor, then we can do that, and explore whether there's a reason for them to actually engage my services.
Okay. And then
So
profession.
it's victoryroad.com is the way to get in touch with me. And that has a way to contact me. My email address is my initials, adp@victoryroad.com. Yeah, I'm on LinkedIn. I guess I'm on the other platforms too, but I don't do a lot on them. So I really like face-to-face, person-to-person stuff. I'm not a mass marketing person.
Hmm. Okay. Yeah, and we'll be sure to share that. And if you like, we can share your LinkedIn too, just so in case somebody wants to get a hold of you professionally, it would easy facilitate that. But perfect. If anybody would
Great.
like, yeah, if anybody would like to get a hold of you, feel free to reach out to him directly through his website. If you like his book, it's there on his website. I'll be sharing all that as well. And if you are a little more shy, feel free to reach out to me, and I'd be happy to make that introduction for you. But if anybody else out there would like to get interviewed, feel free to reach out to me on X at I know a guy underscore. But thanks for your time, Andrew. Really liked hearing more about what you have to say, because your wealth of knowledge, and I could probably pick your brain for another few hours at least. But let's all get out there. Let's go meet some people and get to know some folks. All right.
Okay. Thanks, Anthony.
See you
Appreciate it.
guys.
Take care. Bye bye.
Bye.